Hey everybody, good to be here today. Time for managing your options portfolio. Today I want to talk about rolling options. It's something you hear about all the time. I want to talk about what rolling options means when we talk about that, and look at some individual cases of different types of option trades and potential rolling opportunities. So we're going to do that next. And let me just mention this. I'm joined by Ben Watson. And those of you who were on the previous session know Ben was teaching that. Also, if you're interested in futures, check out Ben's Trading Futures webcast on Tuesdays at 9:30 Eastern Time. He's very knowledgeable on both that and what I'm going to be talking about today. So as you have questions, feel free to type those in the chat between Ben and myself. We'll do our best to get your questions answered. And there's some familiar names in the chat there. I appreciate you joining me. There's some new names in the chat. I appreciate you too. And if you're watching on a recording and you're not participating in the chat, we're grateful for you too. So before we get too far into this, let me just mention a couple things. You can follow Ben or myself on X at Brentmore CS, at Ben Watson CS for additional content throughout the week. Also, options do carry a high level of risk and are not suitable for all investors. And multiple leg option strategies will involve multiple transaction costs. Short options can be assigned at any time up to expiration, regardless of the in-the-money amount. And the material today is intended for general informational purposes only. It's not an individual recommendation or personalized investment advice. A paper money software application is provided for educational purposes only. Paper money application will not assign a short option position early, which is different from a real trading account. For the sake of simplicity, the examples in this presentation do not take into consideration commissions and other transaction fees. And I mentioned rolling. Just note, when you roll an option, it doesn't save you on commissions. You still have to do commissions for each contract that you do there. So just be aware of that. Past performance is no guarantee of future results. All investing involves risk, including potential loss of principal. Okay, there we go. Let's head on over to the thinkorswim desktop software platform. This is the S&P 500, folks. That's an all-time high. We hit an all-time high earlier today on the S&P 500. So Oracle's earnings probably didn't hurt. A milder than expected inflation report, and probably didn't hurt either. So market's just been cruising along here. But we have a portfolio in this class that we look at, and let me just kind of mention that. And I want to go through some of these positions and talk about rolling. But before we do so, I want to talk about what do we mean when we say rolling. So let's talk about that. And for our purposes to start out, let me just kind of mention, let's just say we're going to talk about a long call here. So I'm just going to put LC for long call to remind you of what that is. And I'm just going to make up some numbers here. Let's say we bought a long call. So I'm just going to put +1 for a long call contract. And I'm not even going to put specific dates. I'm just going to say September, and it's a $70 call, okay? And what we decide we do is, I want to extend the timeout on that call. What I can do then is I can go ahead, I could sell that same call. So I'm going to put a -1 to indicate sell. And that's the September 70 call. Okay? And at the same time, what I can do is I can buy, I'm going to put +1 to indicate buy, an October 70 call. And then, so think about what happens here. If I do this selling the 70 call, kind of, we get rid of that initial call option that we had, that September 70, and we're selling it. So these two kind of cancel out. What are we left with? We're left with this. So it kind of looks like, depending on how you view it, it looks like you just kind of changed that September 70 call into an October 70 call when all was said and done. It looks like you just rolled it out. You just pushed out the expiration date on that. That's how it may view, you can view it. That's rolling out a long call, okay? Let me give you another example here, okay? So let's do it. Let's give me just another one. Then we'll look at some real life examples here at our portfolio. But let's say we have a short put. So I'm going to put SP for short put here. And let's say we sold, and I'm going to put -1 for sold in October. And we'll just say a $50 short put. And we decide, hey, I want to change my strike price on that. What I can do is I can look to buy the October $50 strike. And at the same time, I can look to sell in October, and you can choose a different strike. And I'll just, for our purposes, I'll just say 47.50 strike, okay? And so what does it look like? It kind of looks like that, look, I'm buying this one, which is going to cancel out this one or sell it. We're going to buy this one back. We're going to end up with nothing there. And what we end up with is a short October 47.50 put. It looks like we just changed the strike price using the same expiration date from 50 down to 47.50. Now, we can accomplish this through discrete transactions of, I'm going to buy a put, an October 50 put. And then in a separate transaction, I'm going to sell an October 47.50. Or we can do it all at once in what we'd call a rolling order. Now, you still got to pay commissions either way, but you can kind of do it on one order ticket if you want. I'll show you how to do that here in just a little bit. This first example that I gave you here is, this would be an example of rolling out, okay? When we say rolling out, what we mean is we're rolling out in time, okay? This would be an example of rolling down. We're rolling the strike price down, okay? Well, you could roll up. Let's say instead of the 50 to the 47.50, we did the 50 to the $52 strike or something like that. That would be rolling up. Can you roll out and down at the same time? You can. I'm not going to go through that, take the time to write that out. But yeah, you can do both. You can roll out, you can roll down or up, or some combination therein. All right. So that is what rolling is. Now, let me get out of this and let's look at our portfolio. And I want to give you some examples here. So the first example I wanted to look at was Nike, okay? We have an example of, this is a diagonal spread on Nike, but this is one we did in the past, and you kind of informally call this a poor man's covered call. We bought a long $50 September 2026, so this is out a year from now, expiration call, and we sold. Well, let's do this. Let's go back to the account statement and look at the history here on this. So this is what we did originally. We bought the long call, the LEAPS, this is a LEAPS, expires in 2026, and we sold an August 22nd call, and for $99, we sold that. The original LEAPS cost $29.55. We sold it for $99, and then at a certain point, that certain point being August 20th, we bought this back, okay? Remember, we sold it for 99 cents. We bought it back for 6 cents to get us out of that obligation. And then what we did is we sold a new one. We rolled it, in other words. We rolled the 81 call from August 22nd to September 19th. We rolled it out, to use the parlance that we used earlier. And in the process, we brought in a credit, okay? if we buy one for 6 cents and we sell one for 88 cents, that's a net 80, I'm not factoring commissions, a net 82 cent, or using the 100 multiplier, $82 credit to our account. Well, that's great. But the challenge with this kind of trade, of course, is this. We can bring in small little credits, but if the long call just kind of goes south on us, the Leaps call goes south on us enough, it's not going to help us. But hopefully over time, chipping away these little credits are a possibility on this trade. So let's look to roll this again. Why are we looking to roll it again? Well, let me just give you a reason. A couple reasons. One, we only have 9 days to go till expiration on this contract. Number two, the current price on this, it's only about 11 cents left on this contract. We sold it originally for 88. So we've gotten most of what we can get on this. Even if we let this go all the way to expiration, the most additional we can get out of this is 11 more cents on that. So here's what I'm going to do. I'm going to look to roll this contract out. We'll look about a month here and see what kind of credit we can get on this. So when you roll, what contract do you roll to? Forget about the past. Forget about what this did. If I'm rolling, look at it as a new trade. Because it is a new trade. We could just as easily just close out of this one and enter a new one. Now, if I want to do them in the same order ticket, I can do that. I'm going to show you that in a sec. But let's look at Nike and decide where would we roll this to if we wanted to. So let me get out of that. I don't want that. I'm not on Nike. Let's go to Nike. Now, if I'm going to roll this out, I'm going to usually roll very often in this class. We look to roll out about a month's worth of time. So I'm going to go out about 30 days here on this. I'm going to click on this. I'm going to see where am I going to roll. And very often in this webcast, we're going to roll out to maybe somewhere around a 30, 35, somewhere in that delta range there. I'll look for the 30 delta on this. Now, delta tells us how much that option is going to move in relationship to a $1 move in the stock price, but it can also give us kind of a guideline as to how far out of the money something is and in terms of rolling. And in this case, we're going to look for something somewhere in that 30-ish, very general range here on this. Now, we're going to be able to sell that for roughly $164 or so. Okay, so let's just take note of that. That's 10th of October, $80. 10th of October, $80. Let's go back here and let me just show you how we can roll this. I'm going to right-click on the one I roll. I right-click on that. I'm going to create a rolling order. I'm going to click on this. And it doesn't know. We don't have that neural link yet for it to know what I want to roll out to. So I'm going to have to exchange that strike price, that expiration date, to the one I wanted, which was 10th of October, and we said 80. So here I'm rolling it out, but I'm actually rolling it down a little bit too. Okay, but look at what look at what happens here. Okay, this is going to be about $157 credit, roughly, on this. Now, good question. What's the downside? Frank said, thank you, because there's always pros and there's cons on this. There are downsides to this. The downside on this to rolling it out, as opposed to what? As opposed to not doing anything? Well, if we don't do anything and we just let this contract expire, okay, let's say we just let this contract expire, then what we're left with is just a leap. Ultimately, it's a more bullish trade if we don't roll it. Okay, if we just let the short contract that we have right now go away, then we just have that Leaps call. We don't have a short call that's going to cap our gains out. And so you got to reevaluate the trade at times. If on Nike you're just unabashedly bullish, then maybe you just do a Leaps call. You don't try this like kind of income strategy, because this is really an income strategy that we're doing, and do it that way. So yes, there are pros and cons. This is going to limit the potential upside. The pro is we're bringing in about 156 bucks. If the stock kind of goes sideways, that credit is a nice thing. If the stock goes down, that's a nice thing. But ultimately, this is a bullish trade. If I turn super bearish on Nike, I probably wouldn't want to perpetuate this trade. I'd probably just want to get out on that trade. Okay? So let's go right here. And let me just check question. I've heard that in the money delta around 80 or better than a 30 delta. Okay. If you're selling this with the goal of bringing the credit in, if you do an 80 delta, you're going to be in a position, most likely, roughly an 80% chance that this is going to just get, that's going to be exercised on you, assigned on you. Okay. So for this particular trade, for the short contract, not the long contract, but for the short contract, we're going out of the money here because our goal is just to keep the long contract and keep rolling the short contract for a credit there. Now, there are different types of trades where you very well may want to go to a very high delta like an 80 delta. For example, the Leaps contract, you could certainly do that 80 delta if you want. Having said that, there's pros and cons to any of these things that we want. I'm going to confirm and send this order. I'm going to send that. See if we fill. There, we filled. Okay. So now when we talk about rolling, let's go here. Let's look at what it looks like right now. Now, we have 0 contracts here on this. This one's gone. Okay. So what it looks like, hence the term rolling, it looks like we just kind of swapped out this 19th September 81 call for a 10th of October 80 call there. Here's our new situation right there. And keep in mind, when you roll, we're kind of resetting the P&L on those short contracts. So yeah, the Leaps contract isn't looking so hot here, but keep in mind, and we may be down overall on this, but keep in mind, we're bringing in credits along the way to hopefully help us out on that, okay? Help us out, and hopefully we bring in enough small credits along the way as we look at this that it's going to help to offset any deficit in the Leaps contract. So you can see here's the credit. We just got about 155 bucks on that. So that's an example of a roll. Okay, hoping that is making sense, everybody there on that. Let's look at another one. Okay, so that was Nike. That was a diagonal roll. Now, when we're talking about managing these trades, obviously there's a lot of different trades out there. One of the rules we often talk about in this webcast, one of the guidelines, it's not an absolute rule. You can, there's pros and cons to everything. But one of the guidelines is when we start to get about a week till expiration, we look to close out some of these contracts. What's this trade right here on Comcast? Well, on Comcast, we have two short contracts of a 34.50 call. That is, and one long contract of a 32.50 and one long contract of 35.50. That's a skewed butterfly right there. Okay, we originally entered this trade back on the 29th of August, and let me get rid of that. And so far, we're down about 22 bucks on it, so not spectacular. It was actually, I looked earlier today, it was actually up, but it's down now. But we can look to just exit this. But whenever you have this choice to exit, you may also consider rolling. Unlike the diagonal spread we were just looking at, rolling one leg, all of these expire on September 19th. We'll probably look to consider rolling out of the whole shebang here. Now, a butterfly spread is mostly a neutral trade. This is skewed, so this is skewed, so this is actually skewed a little bit bullish here. But let's go and you can always look at the Analyze tab, CMCSA, and look at that risk profile there. And you can see it's skewed a little bit bullish here. But what's happened? The stock was up here before, and now it's gone down here, okay? So that's why we're looking at a little loss here. So if I'm going to roll, you just got to ask yourself, forget about the past. Don't worry about the past. Is this a type of trade that you would consider for a butterfly spread right now? If you're quite bullish, probably not. If you're quite bearish, probably not. But if you're more neutral, which is the general forecast on a butterfly spread, then maybe you consider this. So, and I'm going to say, what if we kind of go sideways here around a 33? So what am I going to look at? I'm going to first look over here. I'm going to look at Comcast, and I'm going to look at the parameters that I would normally kind of look at this. Well, if I'm looking for about a 33 butterfly, then that's the middle strike, 33. The stock's a little bit above that. Then there we go. So 33, and then we can look at other contracts here. And we can evaluate this if we want. We can actually go to the Analyze tab. We can add a simulated trade. Let me go out about a month. Let me get a few more strikes here. And I'm going to look to sell the 33, 2 contracts of the 33, buy a 31, buy a 35. And let's just kind of look and see what that looks like. Let me get rid of the old trade though. We don't want to look at that. We want to look at our proposed new trade. Let's see. Yeah. So that's a butterfly spread right there. This is how it looks as if it were a new trade here. And you got to decide, does this make sense on this? 10th of October. Let me just go to 10th of October for our expiration here on this. Let me set my slices to break even. And it's not giving me 2 slices. For some reason, it's not giving me a second slice there. Let me just put this on. Sometimes it does that. And so here's our break evens at expiration. That's a lower probability trade there. But we can always skew that if we want, if we're more bullish or bearish on this. And so maybe we've shifted our outlook. Before we had a more bullish outlook. Are we more bearish right now? If we wanted to shift that outlook from more bullish to bearish, maybe we skew out this a little bit. And let me just do this. That just made it more bearish. That way, if the stock goes down a ways, maybe losing a little bit, it's showing about a $15 potential loss, but not much risk on the downside in that case. But it's going to add more risk if it goes against us on that. So ultimately, you just need to find what strikes you're going to do there if you want to roll out and perpetuate the trade. And if you don't want to, don't do it. You can just look to exit the trade. Remember, only roll if it makes sense given the current market environment. Don't roll because you're upset because you're losing money on a past trade. So I'm going to create a rolling order. Here we go. Let's see. Does this? One sec. Let me try that again. Let me just right click, create a rolling order. This is going to give me, yeah, that should give me all of them there. Let's see. 32, that's not giving me everything here. Okay, so no worries. So The other way to do it is if it's not looking right here, what you can always do is, first of all, get rid of your old stop orders or exit orders on that. So I'm going to cancel those stop orders or those exit orders on that. Now we're free. And then what I can do is I can just look to exit this contract, exit these contracts, and enter the new contracts. And so I'm not actually going to create a rolling order here. I'm just going to create a closing order, and I'm going to sell that butterfly. And we're going to look to get out. Let me just see if I can get filled here. Confirm and send. Send that order. Hasn't filled yet. We can coax it a little bit here. I can change my price a little bit more towards that natural price to get that filled. It's not filling on me. But then what I can do is that I can just add in my new order that I want. And that new order was a skewed put butterfly. We're going to, you can just click butterfly if you want. 33 was our middle strike. I'm going to click on that. And we said it was going to be a 35, 33, 32. And then I can confirm and send that and send that order to our butterfly. Well, tell you what, I'm going to leave that separate for now. I'm just going to send that order. Okay. So that one's not filling either. Sometimes with butterflies, just a heads up. And this is true for a lot of multi-leg option strategies, especially when you get beyond verticals. When you get a lot of legs in there, it's harder to get it filled as in one unit. Sometimes you break it down to, you could do a short put vertical and a long put vertical individually there, or individual contracts, and get it filled that way. Okay, let's look at some other rolling situations. I'm going to let that roll and work and see if that fills on it for us here. Let's look at another example. So another example we had was Adobe. Okay, so Adobe, let me just move this out of the way here, was a straddle strangle swap. Okay. Good point. Greg pointed out in the chat. I changed it from a call to a put. So we altered the trade. We're not stuck with the original trade. We're not stuck with the original expiration date or strike price. So yeah, we modified that one a little bit. Good, very observant of you, Greg, on that as well. Why did I change it that way? Typically, those short contracts, when I'm looking at a butterfly spread, I want to keep the short contracts out of the money. Now, yes, short options can be assigned early, regardless of how far in the money or out of the money they are, but the odds increase the more in the money they are. So usually I keep those out of the money to start the trade. Now, it may not stay that way, but that's how we're starting that trade there. So there we go. We filled our new butterfly. We can still look to get out of our old one there. I'm going to let that go. Okay, so this is a straddle strangle swap. I talked about this particular trade, this particular type of trade, in the advanced options webcast that I teach on Fridays. I did it last Friday. For those of you watching live, I just put a link to that webcast in the chat. For those of you watching on a recording, all you would need to do is go to the Trader Talks channel. Make sure you subscribe, by the way, and go to the playlists on that channel. And on the playlist, there's an Advanced Options Strategies webcast. And last Fridays, for reference point, if you're watching on a recording, today is September 10th. Last Fridays, we talked about straddle strangle swaps, okay? So this is this trade right here. Notice on this trade, we have different expiration dates. I have these. Again, we're under 10 days to go on these. And I have a longer term. I can look to close out if I want. I can look to roll this out and possibly bring in a credit here on this. Kind of the same principle as the Nike trade that we did before, where we tried to roll for a credit. Well, so let's roll. We're not going to roll all the way to 37 days because that would be, well, that's where our expirations are on our long contracts. I'm going to keep this as a straddle strangle swap. I'm going to look for a short straddle that expires maybe late September, early October. Let's do it. And then look at the rolling trade here. So we're going to Adobe. I'm looking to roll this out. Here's the existing position I have on this. I'm going to go to October 3rd on this. And I don't want butterfly anymore. I'm going to just be looking for a straddle, which is at the money strike, which is 350, or of course I could keep it at the 347 strike. But I'm going to do it as I would an initial position where I'm doing it at the money. So I'm going to go to the 350 October 3rd contract, and we'll see what kind of credit the roll could bring in. So I'm going to highlight those contracts. I'm going to create a rolling order. It shows as a double diagonal, which is what it is. And we're going to October 3rd, excuse me, October 3rd. And that old strike, the 347.50, isn't even available on that. But we said we were going to do a 350. So I'm going to make that a 350 strike on those. And that's given us about a $422 credit. Okay. This is a trade that's more of a neutralish trade. If you look at Adobe and you decide, hey, I'm bullish at this point, don't roll it out. Don't roll it just because we're getting near expiration. Don't roll it just because you did this particular type of trade in the past. Roll it because it meets the parameters of the current trade. If the current trade is more neutral, and I think you can make a case, we're kind of channeling here, kind of more neutral right now, then it may make sense to roll that contract. And in this case, it'd be a nice little credit we'd get there on that. So let me go here. Oops, don't want that. And that's the mid price. I'm going to just go off that mid price a little bit to try and make sure we get filled on that. And I'm going to send that order. And there we go. We sent that order. We've now just rolled out our Adobe trade. And we used to have September 19th expiration. Now we have October 3rd expiration for those short options, one call, one put. And in the process, we just brought in a $400 credit on that. That's a roll. So we rolled that one out and up a little bit, okay? Out from September 19th to October 3rd and up from 347 up to 350, okay? So there we go. There we go. So that is a Adobe. We just rolled that. Now let's go to one that is a maybe a more simple trade here. Let's go and let's just go to long call here on Alphabet. Okay, on Alphabet. So I've got a long call on Alphabet, 72 days to go till expiration. Now, I actually rolled this yesterday in our long option webcast. Notice the roll wasn't because of the expiration date. Before, it was a November 21st expiration. We still have 72 days on this. Why did I roll this? I rolled this because we had bought this trade. We had bought this. Let me go and just go to Google and look at our account statement here. Let's go to our trade history on Alphabet. And I don't need that many days. We're going to go, this was the initial trade there on the 2nd of September. Okay, so let me just go back. There we go. Okay, so this was the initial trade we did. We bought a long call on Google, a $200 call, and it was very nice, okay? The stock went up. It went up significantly. Yesterday, what I did is I sold that $200 call right here. So we bought it for $18.85. We sold it for $42.15. So that is a, what's the credit on that? That was like a 23, if I'm doing my math right, about a $2,300 credit we brought into the account, okay? Because we sold this one for $4,200, we bought it for about $1,900. So roughly a $2,300 credit. Now, we rolled this, not only did we didn't change the expiration date, but we did roll it down. And the reason we rolled it down is this actually got to be a delta of around 87. Okay, that was our delta on this yesterday. I don't have any way to show you that right now, but that's what it was. Because it had gone so well, okay? The stock had gone up so much. We rolled that delta down to, we'll see what our current delta is on this. Our current delta is around 66. So what's the consequence? Well, there's pros and cons of rolling. One of the pros is we brought in that nice credit. That's great. Another pro is by reducing the delta, if the stock reverses on us, if Google goes down, we'll be losing money at a slower rate than if we hadn't done that. The con is, remember there's always cons, the con is by reducing the delta down to 66 from that 87, is if Alphabet continues to rocket up and keep going up strongly, we're going to be making money at a slower rate than we did earlier today, than what we would have. Okay, so we're kind of deleveraging it a little bit. We're reducing the risk a little bit on that trade. We brought in a credit, taking some money off the table, so to speak, to use that expression. But in the process, we do that. So I'm not going to roll it today because I rolled it yesterday. If you're interested in seeing that, you can check out yesterday's webcast and the long options webcast. It looks like Ben did one earlier today as well in his trading index options webcast, where he rolled something from an 81 delta down to a 60 delta. Okay, same principle. You're taking money off the table, taking some risk off the table. Now, and we're taking, but if the stock continues to rocket up, we're also going to be getting a little less in the gains category going forward. All right, so that's how you roll. Now that I've rolled, once you roll, this is a new contract entirely. Okay, this is a new contract entirely. Any old stop losses or anything on there are no longer valid. So you then need to consider adding in your new stop loss here on this. So we have an Alphabet 230 call. What I can do is, in fact, we've actually already done that. Yesterday I bought this for $18.85. Well, it's having a nice day. We're up to 21 bucks here on this. I could put in a stop loss on this, and I'm going to put that stop loss in at about 60% of the current price. Current price is 21.20 times 0.60 gives me a stop loss of about 12.75. Okay, so I'm going to put a 12.75 stop on this. How do I do that? I can just simply right click on it, create a closing order. I can make this order a stop. Remember, stops don't guarantee us to get out. I'm going to make that good till canceled. Stops don't guarantee us that we're going to get out at, what price did we say? 12.75. But it is a common means of trying to protect us. Okay, if Google gaps down, we could blow right through that stop loss on that. But I'm going to add that in as a stop loss just to try and help us out on that trade there, in case it were to fall. So now we've got a stop on that. So we rolled Alphabet yesterday in a webcast. We just added a stop loss on that. Okay, that's rolling. I'm gonna basically, that's what I wanted to present to you today. When you roll, here's kind of the main principles. You can roll strikes up or down. You can roll expirations dates out as well if you want. Or you can do both at the same time. We gave you an example of those. We gave you an example of a roll on Nike on a diagonal spread. We gave you an example of a roll on Comcast on a butterfly spread, on Adobe on a straddle strangle swap, and on Alphabet on just a long call. So we gave you some different examples of various types of rolling. Very often the roll will be initiated because we're getting near expiration, but sometimes, as in the case of Alphabet, that's not the case. We rolled because of delta and other means. Anytime you're closing out, you can always consider a roll. May not be the best situation. And the last thing I would say to summarize is this. When you roll, don't worry about the past trade. Worry about the new trade, the next trade. What's the best strike? What's the best expiration for the new trade? And whether it's even a trade you should persist to be in with. Okay? Hoping that helps everybody. Thank you very much. Ben, thank you for helping me out in the chat, of course. And make sure you subscribe, everybody. Follow Ben and I on X, at Ben Watson CS, at Brent Moores CS. Coming up next, we've got trading price patterns. So everybody, hope you have a wonderful rest of the day, and we'll see you all same time next week. Bye-bye, everybody.